Let me ask you, have you always wanted to buy stocks in the S&P 500? Are you currently living in Canada and wish to trade on the S&P 500 and want to avoid paying the US exchange fees? Well, in this video, I'll be going over how you can do just that, and it's quite simple. Now let's begin with explaining what the S&P 500 actually is. So the S&P 500, or you could say the Standard & Poor's 500, is a market index, and it tracks the largest companies in the US. It carries $5 trillion in assets, and since 1926, it's averaged approximately 9.8% annual return, including dividends. The S&P 500 was estimated to surpass 4,200 points, but year-to-date this year, it's already surpassed 4,500 points from the beginning of January, which started at 3,800 points. So we're well over the estimated profits or returns for this year. It was expected that the S&P 500 would have earned 9.4% at the end of this year, which it's already surpassed. So I'm going to give you an example of what kind of return you would be expecting. So I'm going to give you an example. So let's say you have $10,000 at 9.4%. So I already did the calculation. I can show you guys where I got that calculation from. So with the compound effect, with a compound interest added in here, in 25 years, you'll never guess how much you'll have earned. So your $10,000 in 25 years would have become $103,000. Crazy, eh? And let me give you guys another example. So let's say today you want to invest $50,000, and in 25 years from now, at 9.4%, you will have earned $517,641. And the reason why I want to show you this is because this is based on a return of 9.4%. I also want to show you other calculations after at a higher interest rate, and you're going to see the big difference in your actual returns in the end. So now that you know more about the S&P 500, you might be asking me now, Suzanne, so I'm in Canada, how do I invest in the S&P 500? You're just telling me how much money I can earn. So let me show you how you're going to do that next. So how you're going to do this is you're going to buy ETFs, exchange traded funds. These are funds that mimic the S&P 500. So the biggest companies that offer these ETFs are Blackrock and Vanguard. So these I will go in further detail with you in a bit later. So it's quite simple. The US market is a large market. I would say it's larger than the Canadian market. This is why Canadians want to invest in the US market. Now there are some US ETFs you can buy that mimic the S&P 500 as well, but with the exchange fees, why would you even bother? I remember back, I think it was in 2008, the Canadian dollar was equivalent to the US dollar. So back then that would have made sense. But now I think our dollar might be worth 76 cents on the dollar. So for every $1 US I want to purchase, I have to spend over $1.30 essentially in order to buy $1 US. So out of the 14 investment firms that offer ETFs, I have personally invested in 4. Now again, I don't know what I'm talking about. I'm not a financial advisor. So before you buy any ETFs, do your own research. So what I did before I bought any ETFs is I did a lot of research. So I looked at all the different ETFs that were out there. And out of them, I looked at what they were performing, how much they were earning annually on average, what their returns were for the last 5 years, 10 years, longer, lifetime of the fund. And I looked at how much they were charging for management fees, because that will eat up a lot of your profits as well. Now ETFs will have a lot of different options available. You can buy funds that mimic the S&P 500, the NASDAQ, as well as emerging markets, oil and gas, finance. So there's so many out there to choose from. Now, since the goal today is to look at ETFs that invest in the S&P 500, I'm going to go over 4 funds that I have personally invested in. So the first one I'm going to go over with you guys right now is Vanguard's ETF VFV.TO. So VFV.TO is the symbol you guys are going to look for when you want to buy this ETF. Now, it has assets under management of over $8 billion. The management fees are very low. They're only 0.08%. And their annual average return is over 16% annually. So much better than the market as a whole. Now, the second one I'm going to go over with you guys right now is Bank of Montreal's fund called ZSP.TO. It has assets under management of $9 billion, and their management fees are the same as the other fund. So they're only 0.8%. Their average annual returns are also 16% annually. So again, another fund that will surpass the overall S&P 500 market. So this is the third fund that I have personally invested in. All three funds so far, all are funds that mimic the S&P 500. So this one here is Blackrock's version. Their symbol is XUS.TO. They have assets under management of over $5 billion. Their management fees are 0.10%, and they have averaged 15% annually. So yeah, so all three have been pretty good. Just remember, if you're going to invest in funds like these, you want to look at the performance every year, the performance in regards to how much the maximum you could earn, as well as how much you could essentially lose that year as well. Because just like the market, there's going to be fluctuations. So you want to make sure that when you invest this money that you'll be okay with those fluctuations. Now, the last but not least fund is Horizon's version of the S&P 500, and their ticker symbol is HXS.TO. So they have assets under management of $2.6 billion. Their fees are the same as the previous one I showed you at 0.1%, and their returns are the same as the other one as well, number 3, so 15% annually. So those are the top 4 in my books. But again, you guys want to do your own research, see what type of funds are out there, what type of returns you could expect, as well as what type of losses you could expect certain years. Now, a lot of people that want to invest in the S&P 500 want to do so because they want to take less risk. They know they're investing in 500 large companies in the US, and they know that overall, as you've seen before, the average return is 9.4%. So they also know that if they buy mutual funds, they're likely going to pay higher management fees, and that most fund investors, or I should say fund managers, can't beat the market. So I also want to go over the calculation from earlier where I showed you how much you would be earning annually, previously at 9.4%, but I want to use it now with the 16% annualized rate of return, so you can look at the difference. Earlier, we said $10,000. So with $10,000, if we invested that today, in 25 years from now, at a 16% return, what would we achieve? Now, previously, at the 9.4%, annualized return, we would have earned $103,000 at 9.4%. Now, with the annual realized return of 16%, your return, instead of being $103,000, you're going to achieve a return of $408,742. So that's a big difference in the end result. So now you're probably asking yourself, well, Suzanne, you told me that this year the S&P 500 was earning 9.4%. So how is it that I'm earning 16% and I'm also investing in the S&P 500? So why is such a difference? So what it is the S&P 500 has 500 large companies, but out of those 500, they're all weighed differently in regards to how large they are in market capitalization. So what that means is some companies are earning more money. Those companies will have more value in the fund. So as an example, the top 10 companies that are in the S&P 500 could equate to 30% of the entire fund. So now that you've seen what ETFs are all about, I would love to hear your feedback. So what type of ETFs have you personally invested in before? What you may invest in the future? And I hope you got a ton of value from this video. I love doing videos every week. I love teaching or sharing the things that I have personally learned that have given me so much success. Everyone has the opportunity to do the same. Thanks again for watching, and see you next time.